If your portfolio isn't growing the way you hoped, there's a good chance you're making one or more common mistakes, ones I've seen over and over in the 18 plus years I've been investing. In this video, I'm going to do 3 things. First, I'll expose the common ETF mistakes that cost investors thousands without them even realizing it. Second, I'll walk you through the smart, intentional strategy that helped me build a portfolio designed to avoid every one of those traps. And third, and most important, I'll reveal the worst ETF mistake of all, the one that's quietly sabotaging investors every day. You'll hear it near the end of this video, and trust me, it'll change the way you think about building your portfolio forever. It's time to take control of your portfolio, invest smarter, grow faster, and finally make your ETFs work for you, not against you. Let's dive in. One of the biggest mistakes ETF investors make is not realizing how much their funds overlap. You buy a few ETFs thinking you're diversified, when in reality, you're just buying the same stocks over and over again. Take VU, which tracks the S&P 500 and the tech-heavy QQQM fund. These two ETFs are about 46% overlapped by weight. Just look at their top 10 holdings. We've got Apple at 9.5% in QQQM and over 7% in VU. Nvidia shows up at nearly 8% in QQQM and just over 6% in VU. Then there's Microsoft, Amazon, Meta, Broadcom, and Tesla. Massive companies with major weight in both funds. This isn't just overlap, it's a concentrated exposure to the same top names driving both ETFs. That's a lot of repetition, and this overlap accounts for nearly half the weight of QQQM. These ETFs are heavily tilted toward the same tech giants, which makes sense given the strength of these companies. But it's easy to think you're diversifying when you're really doubling down on the same names. This kind of overlap happens a lot more than people realize, and if you don't catch it, you may think you're diversified when you're really not. And it's not just about those 2 ETFs. I've seen portfolios with 5 ETFs that are 70 to 80% identical under the hood. That's not spreading out your risk, that's stacking fees and duplicating exposure without realizing it. Now, and this is important, some overlap is okay, even strategic. In fact, intentional overlap can be incredibly powerful if you're aiming to overweight certain sectors or top performing companies. Want to lean into tech? Overlapping exposure to Apple, Microsoft, and Nvidia across 2 ETFs might be exactly what you want. But that's only smart when you know it's happening and you've chosen it on purpose. Blind overlap, that's the trap. If you don't know what's in your portfolio, you can't build wealth efficiently or manage risk properly. The key isn't to avoid overlap entirely, but to be intentional with it. Know where it is and why it's there, and make sure it serves your strategy. And mistake number 2 is diversifying into mediocrity. Diversification for the sake of it can backfire. The traditional 3-fund portfolio, made popular by financial forums and authors like Jack Bogle's followers, was designed as a simple, low-cost way to cover all major asset classes, U.S. stocks, international stocks, and bonds. It was praised for its simplicity and long-term safety, and for many years it was a go-to strategy for beginning investors. But here's the problem. In practice, it hasn't worked as well as many had hoped. The classic setup VU, VXUS, and BND sounds smart. It feels safe, but performance tells a very different story. VXUS, Vanguard's international stock ETF, has returned only 5.1% annually since 2011. BND, the total bond market ETF, has averaged about 3.4% over the past 10 years. Meanwhile, VU, which tracks the S&P 500, has delivered 13.6% per year since 2010. You're not getting rewarded for that extra exposure, you're just watering down your returns. Diversification should improve your portfolio, not anchor it. Mistake number 3 is chasing trends without a plan. This mistake is everywhere. Investors hear about the latest hot ETF, maybe a dividend fund, a tech play, or a REIT, and they jump in thinking they're catching the next big thing. But without a clear plan, they're not investing, they're reacting. And over time, that reactionary behavior starts to snowball. Before long, they've rotated in and out of multiple strategies, and they're holding a portfolio that looks like a patchwork quilt of trend-driven ideas. This is how investors end up owning half a dozen ETFs without understanding how they fit together or why they even bought them in the first place. For example, I once talked to someone who went from owning VU to chasing QQQ, then bought into ARK and VUG during the innovation boom, added VGT for more tech, and finally threw in a REIT ETF after they saw a tweet on X. The result, tons of overlap, high fees, and no real alignment with their actual goals. Adjusting your portfolio is healthy when it's part of a strategy, but chasing trends without a plan just creates confusion, inconsistency, and worse, missed growth. Mistake number 4, focusing on yield or growth, not both. On one hand, some people chase high-yield ETFs that pump out 4 to 6% dividends, but what they often don't realize is that many of the stocks in those funds have little to no growth, sometimes even negative total return after inflation. Over time, the income looks good on paper, but the value of the portfolio stalls or declines. On the other hand, there are investors who go all in on growth. They chase high-flying tech ETFs or innovation funds that might have solid appreciation but pay no dividends at all. That works in strong bull markets. But when volatility hits, or if you ever need cash flow, there's no cushion. You're stuck selling shares to get income, which could lock in losses at the worst time. The result, a lopsided portfolio that doesn't actually serve your needs. You might have strong yield, but no long-term wealth creation, or great growth, but no passive income. Neither outcome is ideal if you're trying to build a resilient, well-rounded portfolio. Smart investing isn't about choosing one or the other. It's about balance. Finding ETFs that blend growth with reliable income is the key to long-term success and stability. The best portfolios don't just grow or pay, they do both. Now, before we get into the single biggest mistake ETF investors make, I want to show you how my personal 4-fund portfolio solves every issue we've just talked about. This isn't the perfect solution for everyone, but it's a strategy that's worked incredibly well for me over the years, and it might give you a framework to build your own. Here's the breakdown. VU makes up 45 to 50%. It's my core, giving me exposure to the best companies in America: Apple, Microsoft, Nvidia. It's low cost, tax efficient, and historically one of the strongest ways to build wealth. This is my broad foundation ETF. SCHD is 30%. It gives me income from strong dividend paying companies like Pepsi and Chevron. Its yield is around 3.6%, and it's grown almost 11% annually. Only about 8% overlap with VU, so it actually complements my core holding. This is my steady dividend fund that helps me smooth the ride during volatile markets. QQQM is 15 to 20%. I use this to double down on the tech companies I believe in. Yes, it has a 46% overlap with VU, but that's intentional. I want more exposure to Apple, Tesla, Microsoft, Amazon, the best companies in the world. This is my engine for future growth. And last, I hold VNQ at about 5 to 10%. It's my way to get exposure to real estate through REITs without being a landlord. Warehouses, towers, malls, zero overlap with the others, 3.8% yield, about 7% annual growth. Now let's go back through the issues and how this strategy handles them. Mistake number 1, overlap. I know exactly where it exists and why. VU and QQQM share 46%, but it's the good stuff: Apple, Microsoft, Nvidia. And SCHD only overlaps 8% with VU, and VNQ doesn't overlap at all. Mistake number 2, diversification. This isn't the lazy kind. Each ETF is a different type of exposure: broad market, dividend income, tech innovation, and real estate. No dead weight like VXUS or BND dragging me down. Mistake number 3, trend chasing. Not here. I've held these funds long term. I don't jump from strategy to strategy. Every ETF has a reason for being in my portfolio, and I let them do their job. Mistake number 4, growth or income dilemma. I get both. VU and QQQM give me long-term appreciation. SCHD and VNQ deliver steady cash flow. That's how I manage short-term stability and long-term wealth. And that brings us to the worst ETF mistake of all, and it's not about performance, yield, or even diversification. It's something much bigger. The one that quietly derails more investors than anything else is blindly copying someone else's portfolio without understanding why it works for them. You see a polished chart, a YouTube video, a friend's success story, so you try to mirror it, but that skips the most important part: your own goals, timeline, and risk tolerance. Maybe you need more income. Maybe you already own real estate. Maybe you're trying to retire in 10 years instead of 30. Copying someone else's strategy without aligning it to your needs is like wearing someone else's prescription eyeglasses. It doesn't help you see clearer, it just gives you a headache. And that's why I'm sharing my 4-fund portfolio, not as something to copy, but as an example of how to build a strategy that fits your goals. This mix reflects my priorities. It's taken years to refine. Use it as a guide, but make your portfolio your own. Here's a quick way to start fixing your portfolio today. Step 1, look inside your ETFs. Use tools like Yahoo Finance, Morningstar, or ETFRC.com, which I personally used for this video. Step 2, cut the dead weight. Ask yourself if VXUS, BND, or any other underperforming fund is really helping you. Step 3, build with purpose. Choose ETFs that give you broad market exposure, focused growth, income, and real assets. Step 4, stay consistent. Don't let noise or hype knock you off course. Even small monthly investments, $500 a month, can add up to hundreds of thousands of dollars over time if you're invested wisely. You've got the tools, you've got the strategy. Now it's time to take action. Your future portfolio will thank you. I'd love to hear from you. Let me know in the comments some of your favorite ETFs you hold, and watch this video right here to keep your investing journey going strong. Take care, and I'll see you next time.